Forget smartphones. Teradyne just proved that nearly 70 cents of every dollar they make is now tied directly to the AI boom, and they completely shattered their own revenue records to do it. Yet the stock just fell off a 20% cliff.
It's gravity. You simply can't cheat it forever.
Gravity, right. Well, welcome to Earnings Unscripted, where we try to make sense of that gravity. It is April 29th, 2026, and we're unpacking Q1 2026 for Teradyne, ticker TER. And just as a quick reminder before we dig in, this is absolutely not financial advice, just our personal opinions, so please do not sue us over our market therapy sessions.
Yeah, I definitely wouldn't recommend trading on my existential dread.
No, definitely not. So look, for anyone new, Teradyne basically makes the equipment that tests semiconductors. They test the memory, the custom silicon, even robotics. And this quarter was massive. They hit $1.28 billion in revenue. That is up 18.4% from last quarter, crushing guidance. EPS was 2.56. So they completely crushed it. But the primary earnings reaction concluded as a pronounced 20.4% decline from the prior day's close. Why are they punishing a record quarter?
They're punishing the reality check. Look, the stock gained over 48% just over the quarter leading into this report. So the market was pricing in absolute perfection. But Teradyne's own management kind of threw cold water on it. They explicitly warned that their insane 60.9% gross margin this quarter was basically a sugar high.
Right. They called them non-recurring operational benefits. So it's not structural.
Exactly. The one-time boons are falling off. Guidance bakes in a drop back to the 58 or 59% margin range for Q2. So Wall Street sees that normalization and instantly hits the sell button. Which
feels almost, ungrateful, especially when their operating margin expanded 850 basis points this quarter to 37.5%. They are wildly profitable. But there was another really weird metric that stood out here, right?
The receivables. That is actually the most fascinating part of this entire report to me. Accounts receivable spiked to over $1.1 billion. It was up roughly 40% sequentially.
Yeah, over $320 million of new uncollected cash. Because of what, literal physical buildings?
Yes, it's a pure infrastructure bottleneck. The AI demand is there. The VIP compute customers are placing these massive orders, and Teradyne is actually shipping the multi-system testers. But the AI data centers, physically, they just do not have the facilities completed to receive and install them.
Wow. So it's literally just sitting on loading docks somewhere. It is wild to think about, right? All this bleeding edge compute power waiting on drywall and cooling pipes. I think it really humanizes the AI boom. It takes an army of huge, heavy physical machines to test an AI chip before it ever sees a server.
And physical machines require physical space. The CEO called it lumpy growth. You have verticalized demand colliding with very stubborn real-world supply chain realities. It makes the cash conversion cycle incredibly chunky. And Wall Street hates lumpy.
They really do. They just want a smooth line up and to the right forever. All right, let's get into the details on that lumpiness.
You want the details on that lumpiness? Well, the detail that actually matters here is how they are quietly breaking monopolies. Because everyone focuses on those testers sitting on the dock, but I was looking at what those testers actually are. They just secured their first multi-system production orders for a merchant GPU.
Which is a huge deal, right? Because usually those legacy GPU test contracts are completely locked down by incumbents.
Exactly. It actually validates their fast follower tactic. They realize they don't need to be there at the very inception of the chip design. They just swoop in right after the bleeding edge validation is done and offer better machine availability.
Right. They compete on test speed reliability, not just the initial design.
Yeah. And the CEO, Gregory Smith, actually said on the call, "We are at the heart of the AI wave, and our results reflect the peak demand for AI data center capacity. That peak demand forces these VIP compute customers to look for alternative test vendors because the incumbents just can't scale fast enough."
It really is just an arms race at this point. And speaking of scaling, we should talk about how they are funding all of this, because there is a very interesting chronological quirk in the filings regarding their debt.
Oh, the credit revolver. Yeah, that is a classic balance sheet illusion.
Yes, because if you look at the Q1 snapshot, their short-term debt is officially zero. They paid off the entire $200 million they owed in Q4, spotless. But then you read the footnotes.
Right. April rolls around, Q2 officially starts, and they immediately tap the credit line for roughly $165 million.
It's like cleaning your house just so your parents see it's perfectly clean, and then immediately throwing a massive party the next day.
Pretty much. But look, it makes strategic sense. They're using that draw to buy out Test Insight and fund their multi-lane joint venture. They need those assets right now, not next year.
Because of optics.
Literally. Co-packaged optics. The traditional copper wiring in these AI server arrays is hitting a physical wall. It just cannot move data fast enough anymore.
Right, and they run incredibly hot, so the industry is moving to glass and lasers, Silicon Photonics. And there was this great point on the call about how optical tech used to be this fragile thing that only worked in perfectly controlled laboratories. And Teradyne's new equipment, I think it is the Photon 100, is basically dragging it kicking and screaming into harsh factory mass production environments.
Which is a structural shift. Smith explicitly stated, "We expect that this is a meaningful TAM expansion opportunity, which could reach $300 million to $700 million per year over the midterm." I mean, that is not a small niche. They are buying their way into the physical infrastructure of the next generation of data centers.
Okay, yes, but if they are buying their way in with debt right at the peak of this lumpy growth cycle we talked about, I mean, so where does this actually leave them heading into the back half of the year?
Well, it leaves them honestly hedging their bets. Q2 guidance is actually incredibly strong on the top line. They are calling for 1.15 to 1.25 billion in revenue and, driving EPS right around $2.
Which is basically just repeating that massive Q1 performance.
On paper, yeah, except the gross margins are tapering back to that 58% mark we mentioned. And here is the real tell. They officially broadened their full-year curve. They used to assume the first half of the year was exactly 60% of total revenue. Now they're hedging, saying 55 to 60.
Oh, okay. So they're actively baking in a blind spot for the back half of 2026.
They have to. Michelle Turner, the CFO, had a very blunt quote on this. She noted the low end of the guidance range really reflects the potential for timing impacts, either from lumpy orders or literally, quote, hiccups in the AI data center build-out.
It really all comes back to the drywall. But zooming out a bit, I think it highlights this wild tightrope they're walking. They're riding this huge second wave of AI inference, but legacy stuff, the mobile market is basically stalled entirely right now.
It is totally stalled. Management admitted memory pricing and availability are actively hurting demand outside of iOS. But the AI tailwind is just so massive right now. It completely masks that mobile decay.
Right. So as long as AI stays red hot, nobody really cares about smartphones. But if those data center facility lags start turning into canceled orders rather than just delayed orders,
then that $1 billion sitting in receivables suddenly becomes a much scarier conversation. It's a fantastic strategic position today. They just desperately need the physical supply chain to cooperate.
Let's hope the construction crews work some overtime then. It is genuinely fascinating watching the digital software boom crash head first into real-world concrete. I guess we'll see if those facilities actually get finished by next quarter. If you want these earnings drops to just show up in your feed, go ahead and follow the show. And just a quick reminder that we do use AI to help generate the podcast, mostly to read through those giant 100-page filings so we can focus on the actual conversation. We'd love to hear your feedback or see what tickers you want us to tackle next. So drop us an email at earningsunscripted@datamadness.ca or check the X link in the show notes.
See you next quarter.